a lot of Lemonade investors are wondering, can Lemonade make the jump from pet and renters insurance to car and homeowners insurance? Can they really be successful in these higher premium products, car and home, that are also much more competitive products? Or will they always sort of be stuck, doing well, but stuck in the pet and renters insurance space? And so my question is, if they are stuck in the pet and renters insurance space, what would the valuation really make sense at? And how likely do we think it is that they would ever not succeed in car and home? That's what I want to talk about in this video. If you haven't read this post by Travis Wiedauer, it's a great post. He talks about my Lemonade downside scenario, and it talks about this very thing. Hey, what if car and home are never really successful and Lemonade's forced to really be just pet and renters insurance only? Sort of his downside worst case scenario. He does some really rough numbers here. I'll just give you a glossary of what he suggests and assumes. He says, hey, I think pet and renters are about 60% of our book of business, so say $445 million of premium. And then he goes on to point out, hey, pet and renters both have very good loss ratios, have had for some time, especially renters. Pets are also strong. So he's saying maybe they can make a 10% margin profit on these numbers, which I think is reasonable, which is $44 million of profit. And say you can assume these grow out, 15% a year growth for a long way to come. Pet insurance in the U.S. is a tiny, only maybe 4% or less percent penetration of the market. Not many people have pet insurance in the U.S., so there's huge opportunity to grow that business in the U.S. market. So he's saying, hey, on top of that sort of future growth, 25x multiple is very reasonable. That means Lemonade's valued at about $1.1 billion. And at the time he wrote this, $1.5 billion, 25% or 27% downside, but actually they're probably closer to $1.1 billion right now at the time of this video recording. So he's making the case, hey, even with only pet, only renters, nothing else on the book of business, if they just canceled everything, non-renewed at all eventually, they still could arguably be worth like $1.1 billion. I want to look at two scenarios here in my Lemonade model of what potentially we could think they could be worth for pet and renters only. And I'm going to rely on a few numbers from Domien's Lemonade product mix and loss ratio spreadsheet. He did a couple of videos on these. If you haven't seen them, I will link those down below in the description. Check those out. But he says here, he does a lot of detailed analysis to say what are all the lines of business and their possible loss ratios. And he says, hey, in Q2, pet gross loss ratio was 72%, somewhere around there. And renters was maybe 42%, somewhere in there. And then pet book of business, 23%, and renters was 41% of the entire book of business. If you do the math, that means for pet renters combined, the average loss ratio, the sort of weighted average loss ratio between the two would be about 53% right now. So I'll use a few of those numbers here, and also it means 64% of the book of business is currently in pet and renters, approximately. These are some estimations, but I know these are very detailed, should be pretty accurate estimations. Using those numbers and using my Lemonade model, this is available to my Patreon supporters. If you want to support me on Patreon, it is awesome. You can get full access to the model and play with these numbers yourself. But I had this in a previous video. I showed this valuation model, and you can play with a lot of these inputs here. But I have two more duplicates of that model for pet only. I'm calling one, which is more conservative, and pet renters only, number two, which is more optimistic here. Okay, so jumping to the renters pet only, more conservative model. First of all, the inputs I have is a gross loss ratio of 65%. So it could be even lower than this, like it's probably more in the 50% between renters and pet right now, but saying, hey, longer term, 65% is their average for both these products and the product mix they would have. IFP right now, I take Domien's numbers, his estimate for renters and pet, and then I take 10% off of that. So I'm taking 90% of that to be more conservative. Again, more conservative model for these two. So 480 million IFP. Similar to Travis's numbers, it was like mid 400s. I'm saying, hey, they grow 15% a year of premium. I think this is, again, really reasonable when you consider less than 4% pet product penetration in the U.S. That could really, really grow in the U.S. Lemonade's in the US and across Europe, and they want to expand other places so they could continue to sell renters, pet insurance in more and more of these places. So 15% growth for the next number of years. Operating expenses minus the customer acquisition or growth spend, it's about $370 million now. Now, I'm assuming that just keeps growing 1% a year. In reality, probably the $370 million could have a major slash and be subtracted from that amount, significantly subtracted from that amount, if they really were only hyper-focused on pet and renters insurance. So, but I'm still assuming conservative model stays 370 and then keeps growing 1%. IFP to CAC, I'm saying that ratio is 3. So they spend $1 or $100 to acquire a customer, they get $300 of premium. You can calculate this, you can prove this, which we have. I think in reality for Lemonade, this value will keep going higher than 3, but IFP to CAC of 3, I'm putting in for pet and renters, which again, I think is reasonable. Annual dollar retention, it's more actually for Lemonade, for the whole book of business right now, it's higher than this, which is partly because the premium per customer mix is slowly trending upwards, but it could be, I think it's going to be lower, more like 1 minus the churn rate or the customer retention rate, which would be more around the 84% instead of 88 or 89, what the annual dollar retention is right now for the whole company. Then a little bit of share dilution, 1% a year, and off the 70 million shares that are there right now. And a discount rate of 15% is what I'm using back down to the present. What that gets you is by 2034, they basically 4x the book of business. So you go from 480 million to about just under 2 billion of IFP in 10 years' time. And you get present value right now of, depending on your share price, about into the later 2030s. If you look that far out, share price might be 100 and something per share. So the present value discounted back might be in the range of $14 to $18 a share. So, I mean, if you take these assumptions at face value, you assume they can grow out into the future and become profitable. At some point, the valuation of the stock will catch up with this present value, or it's already at that present value, and it'll still appreciate. You'll still make 15% a year, still a great return, decent return on your money as it appreciates from, the current price, $15-16 a share to $100 a share in 10 years. Not a spectacular return, but still a great return. And this is the conservative scenario I'm trying to lay out, where I think a lot of these numbers are fairly conservative, are estimating more on the conservative side. One thing I want to point out with these models, if you roll over here or you look at, why aren't there more years? Why aren't we showing the present value? It's because I'm doing all of this on when they become profitable from an operating profit standpoint. And last time I showed this valuation model, there were some people that were confused and really questioning, like, hey, even in this, I'll flip over to this tab right here. They're saying, hey, even in this model, as you show growth as the whole company with home, with car, assuming those succeed, they don't become profitable till maybe 2028. Well, what those people are missing when they're asking those questions, or not really thinking about, is that these we're putting in static growth numbers for like the next number of years. So I'm saying 22%, in this case right here for the whole book of business, but they could grow 30% over the next few years, and they could become profitable significantly sooner than 2028. Maybe it's 2026, maybe it's 2027, somewhere in that range. The end of it, the beginning of 2027 is, somewhere in there, they could very well become profitable, but this quick and dirty model is showing sort of an average out into the future, so then you can get sort of an average spread of present values out from the future back to today, and then see if your analysis is really making any sense. So that's the point of what I'm trying to do here. If you wanted to dial in and say, hey, when are they going to become operating profitable, you'd have to put in inputs that you think are accurate for the next 2-3 years, and then ignore the rest of the spread. So anyways, I wanted to point that out because there were some people questioning that or not seeming to sort of get that or understand that. Anyways, though, from this conservative model, I still think it's safe to say, kind of like Travis had pointed out, hey, $14-15 a share, 16, 17, 18, all of that's pretty fair value still to today, even with these conservative values. Now I go to a more optimistic scenario. So we're changing from 65% gross loss ratio to 55%, and that's maybe they increase their pricing for pets slightly. That would significantly improve gross loss ratio. Maybe they continue to bring their loss adjustment expense down. They become more and more efficient with it as a whole. All of that combined, you say 55%, which is what Domien thinks right now. They're actually better than that potentially in those two products in the current product mix. So I don't think this is ridiculous to say 55%. IFP, I went with exactly what Domien had in his model, so $537 million. I'm saying they can grow not 15%, but 20%. I'm trying to sort of max out the more positive, more optimistic across all these numbers, and you can see the range, right? Operating expenses, again, I have the same amount, and they grow 1% a year. Again, I think these would actually get slashed from the starting point, and that would also help your profitability in this scenario get there much sooner. But growing 1% a year, and IFP to CAC 3 again, same annual dollar retention, same everything else, share, dilution, discount rate. Instead of $2 billion, you're at about $3.3 billion IFP in 10 years' time. And you see depending on your PE values, again, what you put in, but present value could be anywhere like somewhere in the $40 to $50 per share. So still, honestly, arguably significantly undervalued in this scenario if they can grow it in the future and become worldwide pet renters insurance company. Now, in this scenario, I'm saying their operating margin, by 2034 is 20%, 21%. So it makes sense they could command a much higher valuation than a lot of insurers would for their book of business, and maybe we worth $14 billion as a market cap because they're hyper efficient in these niche products of renters and pet insurance. And I mean, that's with a PE of 21 on operating profits. That gets you to that. If I flip back, I didn't really talk about it, but in the more conservative case, 9% operating profit by 2036, 2030 range, and a PE of 33, and that trends down here, and you get, valuation again that's in, $7 billion and of market cap, right? So that gives you an idea. I think it's fair to say Lemonade, just pet and renters, could be worth somewhere between what the company's currently worth, from a valuation perspective, up to like $40, $50 a share. I think you can make a pretty good case for that. But again, on top of that, all of this assumes that they only ever do pet and renters. But again, all of this assumes that they're never able to scale into car or home insurance, which I don't think is a very good assumption. I think that's unreasonably pessimistic because Lemonade, they've succeeded well in making an excellent renters pet insurance product. Car insurance management, it seems very, very excited about. I don't know, why wouldn't they be able to build a best-in-class car insurance? Why wouldn't they be able to fully take advantage of telematics and the advantage that could bring in understanding each customer and their risk profile? I mean, they have a young, tech-savvy customer base that should eagerly opt into telematics services. You contrast that to a customer base for a legacy insurer who's going to have probably a lot more customers that are be slow to opt into a telematics service. So why wouldn't Lemonade be able to scale into car? I really can't think of any great reason. In my mind, Lemonade management has a history of overcoming some of the negative narratives and concerns that investors have had. And I don't think it's going to be any different with home and car, or with car especially with that product. With home, I think there's more uncertainty, maybe they can't have an edge over the market, but maybe they can just have an average home product that is added on or tacked on to everything else in order to complete the sort of total bundling option for their customer. Or maybe they just work more as a upfront sales portal for the home product, and they sell that product then out to other insurers who take the actual underwriting risk on. That could be something they do more of as well, some combination of that. But car alone, on top of this what we've talked about in this video, I feel like the upside is just really, really huge. That's how I'm thinking about the renters and pet minimum kind of upside or minimum risk. And on top of that, you have the option call of, hey, they get home right, they get car right. And the upside on that is then massive in my mind. Let me know what you think in the comments down below. Thanks for watching. Remember, it's in the bag.